Hello, Private Investor Club. I'm Ben Brundage, the Director of Investor Relations here at Crystal View Capital. Wanted to give you a quick update, and we're going to go into the Fund 4 update webinar that we just made here in a moment. But for the club, I have some really exciting news. So in the past 60 days, the club has been able to jump two share classes. As you know, we've got an aggregation agreement that allows folks to invest individually, but all of those investments, if you are a club member, get counted together towards higher share classes. So right now we're at Class B shares, and we are nearly to the $10 million threshold. It's where it gets really, really good. The preferred return jumps up to 9% with an 80-20 profit split. So we're nearly there. I just wanted to say, if you are a current investor, if you've invested in this fund, if you have questions, everything's available to you via our investor portal, but we're available. We would love to chat with you over the phone. You could text, you could call, you could email anytime. And that offer stands for someone who might just be interested in finding out about Crystal View, manufactured housing, storage investments, or any questions that are top of mind on Fund 4. Want to offer that to you. It's open. And we hope that you enjoy this update webinar. Thanks so much. Hello and welcome to the Crystal View Capital Fund 4 Q1 2025 webinar update on our fund. I am Ben Brundage. I lead our investor relations department here at Crystal View. Today, I am joined by our founder, Matt Riccadella, our COO, Derek Burgeon, and our VP of operations, Jess Stender. As we jump into this webinar, this is just for educational purposes only. So this is not an offering to solicit an investment. This is strictly educational. Any desire to invest in this offering, please review our PPM in detail here. So I mentioned our team before. We've got an all-star team. We have been in this space for a long, long time. We've been doing manufactured housing and storage for over 20 years now in different capacities, and our fund model here for over a decade. So we're really pleased with our performance here. We'll get into that in our webinar. Now, by our numbers here, like I said, over a decade, over $100 million in distributions to investors. This is probably the number that we are the most proud of here at Crystal View, is our returns that we've been able to deliver quarter after quarter, special distributions, and have a pretty phenomenal track record there. Now, over 92% of our deals have been sourced off market. Matt will go into detail there of kind of how we do that. We've raised over $300 million, which has given us about $600 million in assets under management here over the years. We have assets in about 30 states and manage a lot of units. Do that all ourselves. We're fully vertically integrated here. So with that, I'm going to hand it over to our founder, Matt Riccadella. Matt?
Yeah, thank you for that, Ben. Appreciate that intro. Just want to take a moment and discuss what we believe our advantage is within the marketplace. There's various features that, in my opinion, Crystal View does that's very different than some of our peers and some of our competitors. Hence the outperformance we've been able to deliver over these past 10 plus years. First off, I'd like to notate mostly all of our acquisitions are off market. As Ben highlighted, 92% of those deals come internally. And what that means is we have a dedicated team of salespeople. We have 8 full-time salespeople. They're on the phone, they're on the road, they're meeting with prospective owner operators of manufactured housing communities and self-storage facilities throughout the country. They're building rapport, they're building relationships. And what it's allowing us to do collectively as a team is to not compete with the other groups that are out there buying. So we could buy these deals right. We could go directly to the source. And by and large, a lot of these deals are underperforming in some way, shape, or form. It also allows us to put our value add plan in place right from the outset. That leads me right into vertically integrated. So our platform is vertically integrated. What that means is we have in-house capabilities across the entire organization. So again, deal sourcing in-house, accounting in-house, marketing in-house, investor relations in-house. So everything, we control that process from A to Z, and it's really allowed us to outperform and over deliver to our partners. Got an experienced management team. I have close to 20 years experience in both of these asset classes. Some of our team members have decades of experience in both of these asset classes. We are supported by a corporate staff of more than 50 that are working hard on a daily basis to deliver. And probably most importantly, we're investing in deals on the same terms as limited partners. So myself, along with some of the team members, we're invested in Crystal View Capital Fund 4, Fund 3, Fund 2, and we don't get any preferential treatment. We invest on the same exact terms as you would invest upon. And I think that creates a really strong bond and alignment of interest. Let's talk about the track record. Fund 1 has been fully realized. So what that means is we've sold all of those investments off. We've realized a 47% gross internal rate of return, translates into $34 million of distributions. Fund 2, we're tracking to a mid-20s level gross internal rate of return. We've just about returned back all of the capital that's been invested in this fund in the form of distribution. So in other words, investors nearly got all of their capital back. We still have about $130 million of assets. We're still hitting an 8% cash on cash preferred return in that fund. Fund 3, we're projecting a 19.3% gross level IRR, and we've already made over $35 million of distributions, and that's a 2020 vintage fund. So we're really excited about those results and the progress we've made over the 10 years we've been in existence. And we're going to talk in a moment about some of the progress, some of the distributions, and the performance in Fund 4, which we're obviously very excited about. Lastly, alignment of interest with investors. I've personally invested more than $14 million across all the funds that I sponsor, once again, on the same terms that are available to limited partners. We try to minimize taxable gain within these funds. And the way we do that is we take advantage of the bonus depreciation that's available. So mostly all of our investors, in the first year they invest, they're getting a K1 with a negative net operating loss, but they're getting these really nice distributions. And then last, but certainly not least, think like an owner. So the think like an owner strategy is embedded in our culture, and it starts at the top down. So every member of the team, we're always encouraging them to think like an owner. And that goes right down to a maintenance man, to an on-site manager, to our COO, to myself, and everybody in between. And I think that's really what's propelled us and allowed us to achieve the results that we have over the years. So I want to take a quick moment and talk about MHC. For those of you that have been following us, you know that this is the asset class that we've really been putting most of our focus in as of late. However, I think there's a negative stigma, negative perception that's associated with this asset class. And I think it's inaccurate and incorrect. The perception is, hey, this is trailer trash. And this is personified, by the way, by the picture on the left-hand side of your screen. Society makes us believe that this is really the lowest form of housing that's available out there, and these places are a disaster. The truth is, nothing could be further from the truth. Look at the right-hand side of your screen. This is reality. A lot of these communities are beautiful. And this is a community that we own, by the way. They have wonderful amenities. So we're talking about pools and clubhouses and paved roads and large lots. Most importantly, pride of ownership. These folks that buy homes from us and they live in our communities, they're very proud to call that home their home. And they're building equity in that home. And if it wasn't for us and groups like us that provide that opportunity, they would never be able to live the American dream. So we're really proud of what we do because of that, and also because of the returns that we deliver to our partners. It's really a win-win all around. So again, touching on the track record, let's take a look at the three different funds that we most recently sponsored. Fund one was a 47.9% gross level internal rate of return. We made over $34 million of distributions in that fund, and it's gone full cycle. So we launched it in 2014. We've sold all of those investments off. And I think what's important to highlight here is that IRR is reality. Mostly IRRs are projection into the future. Some groups hit it, some groups don't. Typically, we're known for really being conservative and under promising and over delivering. We certainly did that in Fund One. I think we projected a 20% IRR, and once it was all said and done, we almost hit 50. And at that time, we were ranked as the number one private equity real estate fund with assets less than $250 million. So obviously, we were really proud of that. Fund two, we're tracking to a 31% gross level IRR, and we've already made over $57 million of distributions within that fund. It was launched in 2017. And again, I really am very confident in our ability to over deliver on this fund as well. Fund three, we're tracking to a 22.3% gross level IRR, $140 million equity offering. We've made right around $35 million of distributions in that particular offering. It was launched back in 2020. So let's get into our current offering. This is why we're all here. We have a fund target of $200 million as the equity offering. Minimum investment, $50,000. Target IRRs are 15 to 20% on a gross level. As you can see from past performance, we've continually, time and time again, over delivered there. However, as a disclaimer, past performance is not indicative of future performance. From a preferred return standpoint, we are ranging, dependent on the individual limited partners unit class, 7% up to 9.5% as the preferred return. I've personally committed more than $2 million in this particular offering. And because of its performance and because of the cash flow that's in place today and some of the developments that are upon the horizon, I am going to be increasing my commitment in the near term. I would anticipate within the next 90 to, let's call it 6 months, I'm going to bring another $1 million of my own capital into Fund 4. Portfolio size, we anticipate this being $300 to $400 million once we deploy all of the equity capital. We're making distributions quarterly, and we're anticipating the duration of the fund to be 10 years. So real quickly, we've got 20 assets within Fund 4, 2,200 plus self-storage units. That represents about 273,000 square feet. We have more than 1,600 manufactured housing sites. We've got $90 million of assets under management. And we're really proud to announce that as of Q4 2024, our cash on cash return was 9.2%. So for the first quarter, and by the way, this is a very quick ramp. This is a 2023 vintage fund. Already in that short period of time, we've already ramped up to last quarter a 9.2% cash on cash return. So really excited about that. That's why I continue to bring in my own capital and over time to not miss out on those cash on cash returns. We're encouraging investors that have had interest to get into the fund now, and we're seeing a lot of these folks taking advantage of this opportunity. So let's talk about our asset allocation. So this represents what portion of the fund is dedicated and owned by self-storage compared to manufactured housing. So right now, we have 62.5% of our portfolio is comprised of manufactured housing and 37.5% is comprised of self-storage. We've got a rather robust pipeline of deals that we're going to be closing on within the next 60 to 90 days. If we are successful in closing on these pipeline deals, we are going to be weighted 83.8% to MHC and only 16.2% self-storage. And I think this comes back to just our conviction around that asset class. Just the affordability crisis that this country is going through, and some of the core competencies that we've built up internally with our home sales team, which Derek and Jess are going to discuss in a moment, which has really allowed us to grow our occupancy and has given us a lot of conviction in that particular theme in our ability to grow NOI. So we're really excited about these weightings, and any investor that wants exposure to MH, I mean, this is a great place to get it, especially when you couple it with the cash on cash returns that self-storage provides. So let's talk about that pipeline. We have $39 million of assets under contract today, entirely comprised of manufactured housing communities. And you could see most of these are in the Midwest region, and one of them is in the Southeast. 590 sites in total, and we're projecting $2 million of net operating income this will add to our portfolio if we acquire all of these investments. So this is just a little bit more color on deals that we've recently closed. So on the left-hand side of your screen, this is part of a larger Midwest portfolio that's being purchased in 3 different phases. Phase 1 and Phase 2 now have been closed. So Phase 1, we closed it in December 2024, 237 sites right outside the St. Louis metro, projecting a 26% internal rate of return on this particular deal, 2.8x multiple on invested capital, and a 12% cash on cash return once we add value to this deal and once we execute on the business plan. Now, that's a pretty exceptional cash on cash. That's what's allowing us to already hit that 9.2%. So our process and our strategy is we find these deals off market. We identify where they're underperforming. Typically, we're buying them at a lower cap rate, but we're driving value very quickly, which is bringing us into a higher single digits, low double digit cash on cash return, typically within 12 to 24 months of ownership. Right now, this particular deal is 77% occupied. We're projecting a 16% rental increase in year 1 alone. Phase 2 of that portfolio was a 302 site community in the Midwest, institutional quality asset. You could see the curved roads and gutters there. We're projecting a 20% internal rate of return, which is atypical on an institutional quality asset. 2.4x multiple on invested capital, and a 9% cash on cash return. That return profile is more typical on a B quality asset. This is an A quality asset. It was sourced off market. We're really excited about it. We have a large presence already in this marketplace, and we have regional managers on site that are already executing on that business plan. Some of our assumptions you could see on the bottom right of your screen. We're taking occupancy to 96%, we're projecting by year 6, and we've already done our research in this marketplace. We already own in this marketplace. We're highly confident in our ability to fill vacant sites and sell homes in this park. And we're bringing rents to a market level by year 2. So let's talk cash on cash and cash flow for a minute. If we rewind back to Q4 2023, our coverage was 68%. So what that means essentially is if we had a preferred return of $1, we were only able to hit 68 cents on the dollar. That was 5.5% cash on cash. Looking forward to our most recent quarter, Q4, we hit 108% coverage. So we outperformed our minimum preferred return. That's a 9.2% cash on cash return. The way we were able to do that was, once again, our buying strategy, how we bought these properties right, and how the team delivered in the form of executing on the business plan, getting rents to a market level, filling vacant sites. On our storage side, putting professional marketing in place to grow occupancy, bringing ancillary revenue sources in. That process takes a little bit of time, but once it starts to kick in and materialize, you really see those cash on cash returns start to grow. And that's what you're seeing on your screen here when you compare Q4 of 23 to Q4 in 24. In a moment, I'm going to pass it over to Jess, and she's going to get more granular into the details of which properties really allowed us to drive this growth. So with that,
Absolutely.
I'll pass it over to you, Jess.
Yeah, thanks, Matt. I'm excited to talk a little bit about the outliers that really drove that strong cash on cash return for us in Q4 of last year. The first one up that we have is Speedway. Speedway is one of our performers that we wanted to talk through today. And the biggest piece here is we were able to execute a lease with a national tenant. That national tenant brings us in about $13,000 a month, and they've got an option for an extension at the facility as well. We're continuously marketing land for long-term leases or for sale. We've got this modeled out in both capacities, but the good news is we've got really strong operation pieces happening. And that $13,000 a month with that lease has been a game changer for Speedway. Moving over to Mountain Vista, this is in our backyard. This is here in Vegas for us, and we've completed a huge piece of CapEx here. You can see a couple of these projects listed below: 24 different parking spaces, metalwork, new paint, new doors, renovated the apartments, paving work, restructure work, resurfacing work out there as well. And all of those changes, it almost feels like an entirely different facility when you walk into it. With all of that, we've changed that tenant base as well, and all of that has resulted in a $2.3 million value creation for Mountain Vista alone. So really strong numbers here. The next two we wanted to talk about were on our mobile home community side. Apple Creek, which is part of our portfolio, has brought market rents. Brought market rents to market level, with a 20% lot increase. It seems a little aggressive, but again, it just brings us to that market and makes sure that we're in line with the competitors out there. Since acquisition, we've actually pulled in 2 brand new homes. We've got really strong desire, really strong demand in this market. So that lot rent increase plus the ability to fill those homes is going to be huge for us in 2025. And the work we've done so far has already resulted in a $2.6 million value creation here. Moving over to Clover Estates. Clover Estates is another MHC community. We brought market rents over to market level and completed some community improvements as well. 12% lot increase here, but the community work we've done, I think, is what sets us apart here. Tree work, playground, entrance, really kind of enhance the ability to sell the homes that we've brought in here. It's a beautiful community, and we're continuously upgrading it to make sure that we are attractive. We don't have any issues with that park infill. Very, very confident here. And all of that has resulted in a $2.1 million value creation for this location. And part of what I wanted to talk a little bit about today is how we've done that, how we have had those strong returns on the cash on cash. And we're always looking for ways to improve our structure. Operations is living, breathing, it changes on a daily basis. And we're looking for inefficiencies within our workflows. And I think the biggest piece that we've realized is adjusting 2 different things in our operational structure. One of the biggest shifts that we're moving towards is from a mixed asset class region to really dedicated MHC and self-storage regions. And this is to prioritize those objectives, create some synergy within those regional expectations as well. And in doing this, we're also reviewing opportunities to place key members of our team out into the field. We're empowering our on-sites and our regional teams. They've got tools, authority, and the support that they need to drive those efficiency pieces, improve responsiveness, and enhance that performance at the property level overall. We're continuing to focus on those specialty roles. We had great success with that in 2024. I think Matt had mentioned our MHC department, which has been a huge piece of our park infill and our ability to infill here. Utility specialists, a lot of what we're able to do is because of these specialty departments and that singular focus, we've found a ton of success in. We actually piloted this structure before rolling it out across our entire portfolio and found really strong success in Michigan and Florida specifically. We've experienced higher occupancy rates, stronger revenue performance due to improved execution. And it led to faster decision making and direct oversight for what's happening out there on site. The benefits here are going to be that stronger alignment with those asset-specific needs, that synergistically approach that's happening out there, and just consistently pushing our field team to do the best that we can. And having those strong people out in the field is going to be a piece for us to have that greater control over those key functions within operations. And truly, I think we've covered those key updates here. I think Derek is going to take it next to talk about some operational pieces, broader look at some of the departments and how we're all aligning our objectives to drive that overall performance and efficiency across the organization.
Yes. Yeah, as just mentioned, it's not just operations that we're focused on in the business and optimizing and enhancing how we do things today, leveraging the things that we've done really well historically and going after opportunities as a business on many fronts. And so as we look at our business, it's really all about how do we optimize, automate, and lean into technology, our structure that will allow us to lean into data, making data-driven decisions, getting further away from the analysis and closer to the execution so that we can create value faster. And we're doing this on many fronts. You know, as we talk about data, the bigger we get, the more information we have, and how do we utilize that information to make informed decisions from strategy down to tactics. And so we're currently working on data warehousing, visual analytics, and consolidated reporting across all of our teams that's consistent and available to all of our members from top to bottom. We're looking at marketing, updating our website, how we do customer acquisition strategies and tactics, how we are managing our front-end pricing and our back-end revenue management practices. And if you look over to the right, we give some insight on our ECRI, which is our existing customer rate increase program, and really enhancing not just the volume, but the frequency and which customers that we're touching to get more value out of the in-place tenants that we have today than we've been able to do historically. Well, we're also focused on people. You know, people is what drives our business, you know, from talent recruitment, learning and development, performance management, succession planning, and compliance. People is what makes our business go. And investing in our people is very important to us so that we can continue to drive value, not just for our business, but for them as well as employees of Crystal View Capital. And as Jess mentioned, getting down into the weeds and focusing on the fundamentals. You know, we know that behaviors equals results. And so how do we continue to foster the behaviors that will drive outperformance for Crystal View Capital and its investors and what they've seen historically? And a lot of this is narrowing the focus. How do we make the job easier, clearer, and faster to go out and execute on our business strategies?
Thank you, Derek. Very powerful stuff. I think, you know, it's interesting when we look at what we're doing on a day-to-day basis. You know, we're buying real estate, we're buying dirt, there's storage units, but at the end of the day, it's not really what we're doing. What we're doing is effectively managing people, and we're building a culture, and we're inspiring those that are working with us. And that's really allowed us, that's really the key to our outperformance, in my opinion, because without that, all the dirt, all the buildings, it doesn't mean anything. They're just things laying out there. We give life to them. And what we do on a daily basis and how we innovate and identify how things aren't working and then fix them and diligently work as a team to continually drive that performance, that's what's given us that edge compared to our competitors. So that was just a little glimpse, a peek under the hood, if you will. So really powerful stuff. So let's talk about our realized investments. These are deals we've actually exited. And I've said this time and time again, and I know I sound like a broken record here, but it's conservatism. It's under-promising and over-delivering. We're underwriting typically to a 20% internal rate of return or a high teens level rate of return. But when we actually deliver, when we exit investment from start to finish, you could see here that on average, we're in the high 60s to low 70s, believe it or not. So in Fund 1, we've exited 20 investments. We averaged 70% there. Fund 2, 14 investments. We've averaged 104%. We've had 4 exits in Fund 3 and averaged 31% there. So that's 38 different exits. So it can't be luck. It's not as though there was 3 deals that we exited and we just kind of got lucky. I don't think you could get lucky 38 times and hit that type of return profile. So we're really proud of that. I'm not saying that we're going to hit 68% on all the deals we do in Fund 4 moving forward, but what I am saying is we have a lot of conviction in what we're doing, and we're really, really firm on that under promising and over delivering. It means a lot to us. And I think proof is in the pudding. So with that, I'm going to hand it back over to Ben, who's going to kind of help talk to you a little bit more about where we're at in the capital raise and what needs to be done for those that want to get involved in what we're doing.
Yeah. Well, thank you, Matt. Really appreciate that. A lot is happening here at Crystal View, and we are certainly, as we are growing, as we are acquiring more and more assets, the company is growing, and we're investing in the foundation, bolstering our foundation so we can continue to give our investors the performance that they are used to. And just like Matt said, we really want to over deliver on everything that we do for our investors. So Fund 4, it's currently open, but it's not going to be open for forever. We will close this fund here in 2025. It's got a 2025 close on it. There's still some room. So if you are interested in this fund, there is not a better time to invest than now. As some of you know, we have an adjustable NAV. So every quarter, the net asset value of the fund increases as we are performing our normal business operations. We're adding value to these properties. We're acquiring new properties. The asset value of the fund increases. And so your dollars go a little bit further today than they will, say, 6 months from now. So now is a great time to invest. We've got some stellar acquisitions coming down the pike. If you're interested in finding out more about particular deals that we're closing on, if you've got questions there, if you've got questions about Crystal View, we're happy to chat. You can schedule a call by going to our website. You can shoot us an email at any point. We'd love to connect with you. So thank you for taking time to watch the webinar here and join us today. Thank you, Matt, Derek, and Jess, for giving us color here. We are excited to talk with you and hopefully partner with you in the days and weeks to come. Thanks so much.
Thanks, everyone.